How's it going, everybody? I hope you're having a great day. So today, I want to talk about the stock market. I want to get through it pretty fast, so excuse me if I talk fast. All right, so I'm going to go over the basics of the stock market, kind of how it works, just so you have an idea when people throw, these terms around like dividend or, ex-dividend date or, like what is a share, all this stuff. I'm going to go over real fast. I'm going to give you the lingo of, of the stock market, kind of how it works. This is stuff I've learned. I'm almost 20 years old. I'm still young as can be when it comes to this stuff, but this is all the stuff that I know about. I'm going to try and share with you as fast as I can. So let's get to it. I'm going to start drawing. All right, guys, so if you're around the stock market at all or hearing about it, you're going to hear the term share thrown around. So what is share? It's not a singer. It's actually ownership in part of a company. So most of you all probably know this, but I'm going to explain it to anybody who might not. All right, so let's say that the Coca-Cola company had 100 shares, which it has more like, 30 million. I don't even know how many it has, but let's just say they have 100 shares, okay? And you buy one of those shares, okay? So you got 1 out of 100 shares, right? Well, that means you own 1/100th of the company, which is kind of a cool thought. So when you actually invest in a company, you do technically own the rights to a certain percentage of that company. Now, like I said, basically with Coke, if you were to buy 1 share of Coke, you're really only owning like 1/300 millionth of Coke, okay? But it's still a cool concept. And as long as they retain 51% of their shares, then they get to make all the shots with their company, okay? But if, say, someone were to, buy 51% or 52% because the company made a mistake, well, if I bought 52% of, the Coca-Cola company's shares, then technically I could call all the shots for them, which means getting rid of blueberry Coke because it's disgusting. All right, another thing, a little bit of lingo you hear is buy low, sell high. Okay, what does that mean? Well, it simply is exactly what it says. So you're going to want to buy a stock when it's lower, sell it when it's higher. That's how you make your profit most of the time with stocks, although there's different ways I'll go into in a little bit. But so for instance, if Coke, which sells I think for about $120 a share, we'll just pretend it sells for $5 a share. So if it sold for $5 a share and it goes up to 20, well, you better freaking sell it because you're making a 300% return on investment, which is incredible in the investing world. Okay, so another term you might hear thrown around is the term dividend. So what the heck is a dividend? Okay, a dividend is when a company is willing to pay you a very small amount of the overall price of the share of the company in order for you just to hold on to that stock. It's basically kind of like you can think of it as a way of rewarding a customer. So you know how like certain grocery stores and stuff will have rewards programs so you can, get points and, basically save money in that store because they value you as a customer, which some of them do. Sorry, quotation marks, maybe not the best idea. But, some of these companies are willing to basically say, listen, if you're a good customer and you're willing to hold on to the shares of the company, then we'll pay out a little bit of our overall profits of the year to you so that you can make a little bit of money just for owning the stock. And it's kind of neat, but anyways, that's basically what it is. Let's say that GoPro sold for $5 a share, all right? And they gave you a dividend, which is normally abbreviated DIV, just so you know, of 50 cents, right? Well, you figured that's actually 10% of $5, which is extraordinarily high for a dividend. They're normally more like anywhere from 1 to 5%, and 5% is a pretty good dividend. But that's aside from the point. Basically, GoPro would say, hey, in order to keep you with us, we are going to pay you a certain amount of money just to hold on to our stock, just to own it, all right? So there you go. That's just a rough example of what a dividend really is. Okay, so 2 things you need to know about dividends real fast. 2 very important dates. So you have your ex-dividend date and your dividend payout date. So the difference between these 2 things. Okay, the ex-dividend date, that is the last date, the last day you can buy the stock and still receive the dividend that will be paid out in the next quarter, right? So what does that mean? Basically, companies don't want you buying the stock the day before they're going to give the dividend out and then turning around and selling everything. It doesn't look good for the company. So what they'll do is they'll say, okay, let's say June 6th is our ex-dividend date. If I buy the stock before June 6th, then I receive the dividend. But if I buy it after June 6th, well then, I don't receive the dividend. I still have the stock. If it goes up in price, I can sell it, all that good stuff. But I don't get the dividend, right? So important dates to know: ex-dividend date and the payout date. So the payout date is the actual date that the company will be giving you the dividend. It will transfer into your account. So that's a dividend payout date, and that's an ex-dividend date. All right, calls and puts. You'll hear these, put out there. So you hear of covered calls and all this stuff. So what the heck is a call and what the heck is a put? Okay, so a call is when someone is willing to bet that a company is going to, their share price is going to basically skyrocket. Whereas a put is when someone is willing to bet that, the company's share price is going to go downhill. All right, I'm going to get a little bit into that right now. So here we go. Okay, so I'm going to go over a real life scenario. I own this company. I did this exact deal not but a week ago. So I'm going to try and explain to you through that deal how covered calls work. Hopefully this helps you. So here we go. I know there's a lot of numbers on the board. Don't get scared or intimidated. I'm going to run through them relatively fast, and I'll teach you all what they mean. Okay, so first off, something you need to know before you ever get into calls or puts: you have to own 100 shares of a company in order to do a call or a put. All right, and that's just how they do it. They bundle them all together in 100 share packages, basically. So you can't just do this with one share, because the people who are willing to bet on a call are wanting to make a big cash payout. So they won't deal with less than 100 shares of stock. Okay, so you have to own 100 shares. So I'll kind of teach you how this worked for me. So Trevana is a company. It's a biopharmaceutical company. I won't go into what that means, but basically, Trevana is a company that sold for about $1.50 a share. It was more like $1.43, but I'm gonna round it up so it's an easy number. So we'll just say that it sold for $1.50 per share. All right. So in order to get 100 shares, I had to pay $150. Okay. So $150 got me, 100 shares of Trevana. Fair enough. Okay. So I own 100 shares of the stock. Now what happened? So I went to sell a covered call, and someone was willing to offer me 15 cents per share. Okay. Now, like I said, they come in 100 share bundles, and so basically that's $15. All right. So we got a premium for 15 cents per share. I bought each share at $1.50. So 0.15 times 100 is 15. So I made $15 instantly off the deal. That's my money to do with what I please. Okay. So automatically I got $15 from the person. Now, what exactly did they pay me $15 for? Right? That's a question you should be asking. So they paid me $15 for the opportunity to buy my stock at $2.50 on August 17th. So basically, right now I'm in mid-July. They're willing to bet that Trevana is going to skyrocket. They think it may go, whatever, $3, $4, $5. But what they're paying me for is the right to my stock. They're paying me for the right to buy my stock at $2.50, which is still a huge jump from $1.50. Okay, that's incredible. They're willing to pay me per share $2.50, but they've already paid me $15 for the right, just the right to buy my stocks at $2.50 on August 17th. So it's kind of a win-win here. So basically, if the guy that made this bet, who made this covered call and bought it and paid me the money, if he's right and this stock goes to $5 or $10 or something crazy like that, which is what he's betting on, then come August 17th, it's still at that price, I have to sell that stock to him at $2.50 a share, which means basically, let's say it went to $10. Well, then, what he does is he buys all those shares from me at $2.50, turns around and sells them at $10, and you can see for yourself that's like a 300% return on investment. That's really good. Now, what happens if my stock does not get to this $2.50, which is called the strike price? It's the price that the person sets at which they're willing to pay you for the right to buy the stock. Okay, I hope that's not too complicated. But so what happens if Trevana does not go up to $2.50 by August 17th? Well, here's where I win. If it doesn't go to $2.50, then I keep all my shares and I keep the premium which he paid me. All right, so I hope that makes sense to you. Basically, if my stock does not go up to $2.50, which even, I mean, you figure the numbers on that too. If I bought it at $1.50 a share and I sell it for $2.50 a share, that's still an incredible profit. Plus, I already had the premium in my account, which is good. The other thing that he's thinking about when he buys this is, I could pay you $15 for the right to buy your stock on August 17th, which he doesn't have to do, even if it were to hit $2.50. He doesn't have to buy it. He's not required to buy it. He can choose to. All right. Even you know, if it hits to $2.50 and he's like, I don't, you know, I'm not going to make any money off of this, he can just keep it. He's not taking on hardly any risk of owning all this stock, whereas I hold all the risk. So, for instance, what happens if Trayvana goes from 150 at its current price down to 75 cents a share? Well, guess who's losing all that money? That's me, okay? Not him. He's only paid for the right to buy it at this time, which he doesn't have to do. And so, you know, obviously if it's at 75 cents, he's not going to buy it for $2.50 on August 17th. All right, fair enough. So basically, that's how covered calls work. Somebody's willing to, you know, pay someone else a certain amount of money for the right to buy stock, you know, at a certain price, at a certain date, so that if that stock goes crazy, skyrocket up, then they get to buy it at a much lower price, turn around and sell it and make a very large profit. So there you go. Okay, so puts. I'm going to be dead honest with you guys. I'm not going to try and fake this. I don't know a ton about them. Basically, puts, it's the opposite of a call. That's about as much as I know. And I like calls a lot, so I've never really gone down the rabbit hole when it comes to puts. I do know it's betting that a company is going to do poorly. All right, so the person before who was willing to bet that, you know, Trayvana was going to go up through the roof, well, this person's willing to bet that Trayvana is going to hit rock bottom. And somehow they make out like a bandit. I don't really get into it because I don't negatively bet on companies. That's just not how I roll. But there you go. That's basically the basics of what a put is. Okay, a ticker symbol. Very simple. It is literally the abbreviated letters used to represent a company on the New York Stock Exchange or whatever exchange you're using. So, for instance, the Coca-Cola Company, their ticker symbol is represented by a K and an O. Trayvana, the company I was talking about before, is a TRVN. That's Trayvana. You know, other ones, Apple, APPL. You know, it's very simple. A ticker symbol is basically the letters used to represent a company on whatever stock exchange they are on. Hey guys, okay, so real fast, a couple things I want to go over. The stock market, I believe, is open from 9:30 to 4, Monday to Friday. It's closed on the weekends. You can trade anytime during that time frame. Another thing I wanted you to know, the stock market, you know, it's very educated gambling. That's the way that I've always been taught that it is. I'm not trying to convince anyone to get into it. I'm just trying to educate you on what it is, how it works. I like it, you know, and I'm not a big gambling type. I've done decent for myself. I also would recommend just being wary about people who try and give you, you know, quick fixes to becoming a millionaire on the stock market. Be wary about it, because a lot of people are out there claiming, you know, they've made it big and they've, you know, struck gold with the stock market. And in order to actually have incredibly high, fast returns, you have to put a lot on the line, and you invest in very risky companies, which, yes, they could do well, or they could do very poorly. In my opinion, the best type of game on the stock market is the slow and steady, you know, just hold on to your stocks or sell them when you need to, but don't try and constantly, you know, make incredible returns, because you're going to end up failing, in my opinion, more times than you would succeeding. So I don't recommend getting into crazy risky stocks. That's just where I stand. But once again, all this, it's up to you. You make the right calls. Anyways, thanks for watching Man in the Making. Something I do want to go over real fast. I use Robinhood. Okay, Robinhood is it's a trading app. They don't have any brokerage fees. A brokerage fee is when you basically have to pay a company in order to buy a stock. It sucks. Be dead honest. That's why I went to Robinhood. Something about Robinhood that is interesting, I'm going to put a link down here. If you join through this link, no, I'm not going to, that's bullcrap. You can join straight through Robinhood, or you can go through my link. And if you go through my link, you get a free $5 stock automatically, as do I. I benefit as well. You have like a 1 in 200 chance of getting a stock that's over $100. And so basically they're trying to entice you to join by saying, hey, we'll give you a very cheap but free stock. And I like free stocks. I like free shares of companies. That's pretty cool. So if you want to help me out, go through the link. If not, you can go straight to Robinhood's website and go through that. And I think you still get a $5 stock. So, you know, do what you want, but help me out. I'd appreciate it. Anyways, so yeah, Robinhood, that's what I use. No brokerage fees. It's very simple. It's an easy format. That's what I recommend if you were starting out. So anyways, I'm going to stop rambling on. Thanks for watching Man in the Making. I hope this educated you somewhat on what the stock market is, kind of, you know, the different words used and associated with it. And, you know, if you get into it, good luck, best of luck to you. I hope you do really great and you make a lot of money. But, you know, I think, you know, it's good to understand how it works because it is, for a lot of people, it's kind of an important part of their life. That's how they bank their retirement. So just something to think about. Thanks for watching Man in the Making. Have a great day and please subscribe.